right, in detail. Then yesterday we were studying the second part, but then there were a lot of words, buzzwords, which were coming again and again. So we had to kind of go a little wayward, right? We have to learn a little bit about maintenance. Yes or no, Hira? Nida joined later, so you understood?
Yes.
Yes, okay. All right. So what we'll do, we'll not go further, right? There is a reason why I'm not going further, because all these are questions, right? All these are, I can do it. I don't mind doing it, but till the time you don't, right? So what I want you to guys to do is that, because after this 4 5 question I have to do, and the last part of the chapter, if I this question will be tricky. I don't want, and then we have questions. We have a lot of questions, right? 37, right? Okay, so we'll take some time, but that's okay. My point here, because in the last class, right? So now, after discussing the concept in the last class, it's time to do the questions, right? So, uh, the first question here is, question number 18 is, Perry Louis Robert just purchased a call option share of the Michelin Group. A few days ago, he wrote a put option on Michelin shares. The call and put options have the same exercise price, expiry date, and number of shares in the line. Considering both positions, Robert exposure to the risk of stock on the Michelin Group is okay. So what is happening here? If you try to understand in easy way, right? What is happening here is that uh, just break it down, right? The overall position is he buys a call. So when do a person buys a call? When he's a bullish, he benefits if the stock goes up. He writes, he sells a put. Also bullish, you're obligated to buy if price kind of falls. So very important to understand is long call is a positive exposure to the stock. Short put also is a positive exposure to the stock, right? So in both cases, if stock rises, call makes money. If stock falls, put seller loses, forced to buy at higher price. So long call plus short put is kind of synthetic long stock, right? So remember that. So long call plus short put is equal to your synthetic long stock, right? This is one of the most important identities in derivatives. So this is a long answer, right? Okay. Answer is okay. I've taught you options in great detail to understand. Go back and let's solve the question. Okay. Okay. This is the answer here. Then go to the next question. An online brokerage firm has set the minimum margin requirement at 55%. Okay, but the maximum leverage ratio associated with the position financed by this minimum margin requirement. Again, see, margin required is 55%. Then we go to the leverage. Leverage is equal to what? Leverage is equal to 1 by your margin requirement. Right? So why? Because you only put 55% equity, rest is borrowed, that is amplifying your exposure, right? So in fact, let's say you invest 55 rupees and you control 100 rupees, that's leverage of 100 by 55, right? So this is 1 by 0.55, right? Which comes out to 1.82. Okay, B is the answer. Okay. Going to the next question, question number 20. A trader has purchased 200 shares of a non-dividend paying firm on margin at a price of rupees 50 per $50 per share. The leverage ratio is 2.5. 6 months later, the trader sells these shares at $60 per share, ignoring the interest paid on the borrowed amount. Ignoring the interest paid on the borrowed amount and the transaction cost. What was the return to trader during the 6 month period, right? So again, see, buy price was yours 50. Sell price was 60. Leverage was 2.5, right? Buy price 50. Sell price 60. Leverage 2.5. Okay. So step one is what? Calculate unleveraged return, right? Which will be 60 minus 50 divided by 50. The unleveraged return, guys. Unleveraged return. This comes out as 20%. Okay. Then you apply leverage. You apply leverage. Yes, and it makes it 50%. Okay. So leverage kinds of amplifies the gains, amplifies the losses as well, right? So that's what you need to understand. Very simple question, like very, very simple question. Please understand uh, the total position was $50. Equity was 40. Why equity was 40%? Because it was 1 by 2.5, right? 1 by 2.5 gives you 40%, right? So zero point 0.4 into 50 is equal to 20. And since the gain is 10, right, it is 10 by 20, which is 50%, right? So whatever method, right? There's another method to solve it, which I told you just now. But the idea is that whatever way you use. This is easy way, but I've done another tricky way is that you understand the total position is 50, right? If you want to understand different way, the total position was 50 another way, guys. Total position 50. Now since it was 1 by 2.5, right? 1 by 2.5. So leverage equity is equal to 40%, right? And equity is equal to your zero point 0.4 into your 50 is equal to your 20, right? So return is equal to 10 by 20 is equal to 50%. Okay. Another way, right? Do whatever way you like it. Okay. Then we get into your question number 21, right? Uh, Jason Williams purchased 500 shares of a company at $32 per share. The stock was bought on 75% margin. 1 month later, Williams had to pay interest on the amount borrowed at a rate of 2% per month. At that time, Williams received a dividend of 0.50 per share. Immediately after that, he sold the shares at $28 per share. He paid commission of $10 on the purchase and $10 on the sale of the stock. What was the rate of return on this investment for the 1 month period, right? Again, this is where students struggle, right? Because you have to understand how this works, right? See, the question here is that shares is equal to 500. Here's a 500 price is equal to your $32. Okay. Now, if I have from 15 to 32, right? So total will be is equal to your multiplication, right? Which comes out to 16K, right? Now, total 16K, margin is 75%, right? Margin is 75%. So if I take 16K margin into 75%, means your equity is 12,000, right? So equity here is your 16 into 0.75. 16K into 0.75. It makes it 12K. Okay. So basically equity is 12K. The borrowed amount is 4K. Okay. Now, okay. Now, what you need to understand here is the cash flows, right? So if you are now kind of selling it immediately after he sold the shares at $28 per share, right? So basically, uh, if I look the cash flows here now, if I look at the cash flows, okay, so my sales is equal to 500 into 28 is equal to your 14K. 500 into 28 is equal to 14K. And then there is a dividend, right? So dividend here is your 250, right? So in these kind of thing, this is positive, right? This is negative, right? Positive and negative, right? And negative is the purchase, right? Purchase is your 16,000, right? So, and the interest paid is interest on this is your 2% on the borrowed amount. Borrowed amount was what? 4K. This one, na? Which is bringing out very meager amount, 80. And commission is, yeah, commission is, yeah, $10 on the purchase and $10 on the sale, right? Which is 20. Okay. Now, if you solve this whole cash flow thing, right? 14K input, 250 input, minus 16K outflow, 80 outflow, 20, right? If you sum up, right, cash flows, right? Total cash flow will become, right, your minus 1850. 14K plus 250 minus 16K minus 80 and your minus 20, right? Minus 1850. And this minus 1850 is kind of your net profit and loss. And then what you'll do is you're looking at return, right? So question is asking what is the rate of return, right? So if I have to calculate the rate of return now, rate of return, right? So it is minus 1850 divided by 12010 is equal to minus 15.4. Okay. So very interesting question, little bit lengthy, but understand first calculate the total amount, calculate the equity, calculate the borrowed amount because interest will always on the borrowed amount, right? Cash flows, positive and negative, sales you have done, dividend you have received, that's the input, purchase you have done, that's the outflow, interest you have paid, outflows, commission outflows, and total is minus 1850 and 1 divided by your 12,010. Why 12,010? Because 12,000 plus 10 commission, right? 10 commission is the which you purchase, right? Purchase it right? Minus 1850 and 12,010, right? So minus 15.5, right? So leverage increases the loss speed also. Even small price drop has loss. So B is minus 15.4. Okay. Go back to it. Very, very important. Then we go to question number 22. Caroline Rogers believes the price of the Gamma Corp stock will go down in the near future. She decided to sell short 200 shares of Gamma Corp at the current market price of your $47. The initial margin requirement is 40%, which of the following is an appropriate statement regarding the margin requirement that Roger is subject to on the short sale, right? See, in this question, what is happening is that you are shorting 200 shares at 47, right? So if you're doing 200 shares of 47, 47 into 200, 9,400. Margin is given as your 40%, right? So which is, you know, 40%, right? The thing, right? Now, the critical concept, which is often misunderstood in your short selling, is that you receive the proceed of 9,400 that is kept as collateral. You also need to deposit margin, right? So the requirement is 40% of your 9,400, right? So which is your 3760, right? So 40% of 9,400 is 3760. Now, students often think that I already have sales proceed, why extra margin, right? No. In short selling, because losses can be unlimited in short selling, you have to deposit, right? So answer is you'll need to contribute 40% of your 40% of your what you say 9,400, right? So 3760, and you have to contribute, right? That is the margin. 40% of your 9400. 9400, how did you get? 47 into 200. 47 into 200, 9400, or 9400 into 40% of that, right? 9400 into 40% of that. Okay. So remember that. Okay. Not very difficult, but keep this in mind. Then next question we have. Next question is the current price of a stock is $25 per share. You have $10,000 to invest. You borrow an additional $10,000 from your broker and invest $20,000 in the stock. If the maintenance margin is your 30%, at what price will a margin call first occur? Right. So it is very interesting. Again, what is happening is that stock price is 25. You invest $10,000. So basically, you borrow, uh, or you have $10,000 to invest. So you borrow an additional $10,000 from your broker also. So total position becomes 20,000. So shares bought is what? 20,000, and the share price is 25. Now 20,000 divided by 25, right? So that is you have bought 800 shares, right? Now, if the maintenance margin is 30%, what price is the margin call, right? So basically, you have bought 800 shares, and margin call happens when the equity by market value. So basically, margin call happens when equity, right, by your market value is equal to your maintenance margin. Okay. So market value is what? Market value is what? Market value is your 800p. Loan is your 10,000, right? So equity is equal to what? Equity is equal to market value minus loan, right? Equity is equal to market value minus loan, right? So equity is equal to market value. Market value is 800 shares multiplied by the price, whatever you have, minus your 10,000, right? So that is what you have, and divide by your market value. So same thing. So in the numerator, you have 800p minus 10k. Denominator, you again have 800p market value. This is how you find the equity value, na? Right. Equity value was what? Market value minus loan. Market value is what? Your 800p. Right. This is equal to 0.30. Then we can calculate the P, na? We calculate the price, right? So P comes out as 17.86. Right. So when price falls, equity shrinks faster than value because that is kind of fixed. That's why leverage is dangerous, right? 17.86 is the value, right? Okay, calculate P here, right? So overall, all these questions are very important. We have completed all these questions. You have to go back and understand and solve these questions, guys. Whatever way, right? I have solved in different ways. Uh, Somebody has solved in different ways. Standing on a book for a particular stock, the bid and ask sizes are number of shares in hundreds, right? So if you look at your what is the market, right? So market, if you look at, you have, you are, what are you trying to do, right? So you offer size, you see, offer size is 10.02, 10.10, 10.14, 512, 18. And your bid size is 512, 460, right? So best bid is what? Best bid is this now. Best bid is 9.95, right? And what is the best ask? Best ask is 10.02, right? So the market is 9.95 and 10.02, right? Okay. So see, you have to understand the bid and ask, right? Bid is required. So basically, the market is 9.95 bid, offered at 10.02. Best bid is this, ask is this. Okay. All right. Then once we have seen this, again, next example, consider following limit order book for a stock, the bid and size are given. Right. Same thing. A new buy limit order is placed for 300 shares at 123.40. The limit order is set to what? So new limit order is 123.40, right? So best bid is what? Best bid is 123.35. Best ask is 123.80, right? So the new bid is basically greater than old best bid. So it improves the market kind of, and new bid is less than the best ask. So no execution, right? So it improves the bid, but creates a new bid level, right? Execution doesn't happen, right? So it kind of makes a new market, right? Right. So that's what we have. See, if you are improving your bid ask, you are making a new market. If you are matching the best bid ask, it is make the market. If you crosses your spread, right, then it's take the market, right? So understand it, right? Take the market, make a new market, right? So if you're improving your bid ask, which is happening in this case, you're making a new market. If you matches the best bid and ask, that is make market. So one is make new market, one is make market. When you're improving bid ask, which was in the previous case, you were making the new market. In this case, you are sorry. In this case, it is improving the bid ask. It's making a new market. If you are matching the best bid ask, which was the previous question, it is like make market. The crossing spread, it is like take market, right? So remember that. Okay, you have to remember that. Okay. Then the trap here is very important question. Currently, the market in stock is 54.62 bid, offered at 54.71. A new sell limit order is placed at 54.62. This limit order is set to, see, market 54.62, 54.71, 54.62 bid, 54.71 ask. New sell is 54.62, right? Sell price is equal to best bid. Immediate execution will happen, right? It execute instantly, so you are taking the market, right? Okay. So taking the market is what? When it execute immediately, right? So which I told you earlier also, that if you are making new market, right? If you're improving bid ask, making new market, if you matches, it make the market. And if you process spread, right? So your ask goes to the bid, right? You take the market, right? So that is what you have, right? Remember the small definition, guys, nothing else. Once you have understood, you will find. Okay. Then the next part here is you have placed a sell market on open order, a market order that would automatically be submitted if the market open tomorrow and would fill at the market price. Your instruction to sell the share the market open is what? Right. If you have sell market on open order, what type of instruction it is, right? So it is when to execute. It's kind of a validity instruction, right? So it's not an execution instruction, not the clearing, right? It's a validity instruction, right? So keep that in mind very, very clearly, right? Validity is like when to trade. Execution is about how to trade. Clearing is about settlement, right? So please keep in mind, right? Validity is when to trade. So tomorrow morning it will execute a market price, right? So is when to trade, right? Then execution is how to trade. Clearing is settlement. Okay. So remember when, how, and settlement. Then we have practice question number 28. Your Jim White. Jim White has sold short 100 shares of Superstore at a price of $42 per share. He has also simultaneously paid a good till cancel stop 50, limit 55 buy order. Assume that if the stop condition specified by White is satisfied, an order becomes kind of valid. It will get executed. Excluding transaction costs, what is the maximum possible loss that White can have, right? So again, it's a short sell at $42, right? And if order is placed, right, the stop price is 50, limit is 55 buy. So shares is your 100. So what does this mean? This is a stop loss for a short position. The price rise to 50, order kind of activates, then becomes a limit buy at maximum 55. So worst case is you buy back at 55, you sold at 42. So 55 minus 42 is 13. So total loss, is 13 into 100, 1300, right? So that's the worst case loss you can have, right? Please understand, stop limit is not the guaranteed execution price, but here question assumes your execution happens at stop limit, which is 55 limit buy, right? So without limit, losses could be unlimited. With limit, loss is capped, right? Which you need to understand. Then we have next question. You own shares of a company that are currently traded at $30 share. Your technical analysis of the share indicates a support level of 27.50. That is, if the price of the share is going down, it is more likely to stay above this level rather than fall below. The price does fall below this level. However, you believe that the price may continue to decline. You have no immediate intent to sell the shares, but are concerned about the possibility of a huge loss if the share price declines below the support level. Which of the following types of order could you place to most appropriately address your concern? Right? See, current price 30. Okay, support level 27.5, right? So you are holding share. What is your fear? Fear is price falling below the support, right? So what do you want? You want protection only if your price falls. So correct strategy is place a stop sell below your support. Why? Because the price breaks support, you sell immediately, protect your downside. If you do short selling, that's the opposite position. You'll have massive losses. Stop buy, use for your upward movement, right? So best answer is GTC, good till cancel, stop sell order, right? Stop sell order, right? So when you want to protect your downside, you stop sell. When you catch your upside, you have stop buy, right? Protect downside, stop sell. Catch upside, stop buy, right? Please keep this in mind, right? So answer here is B. Okay. Then we have question number 30, which is there. In an underwriting offer, the risk that the entire issue may not be sold to the public at the stipulated offering price is borne by the who bears it, right? See, this is a firm commitment underwriting. Investment bank buys entire issue from issuer, sells to public. If public doesn't buy, bank is stuck with unsold share. So that is your investment bank, right? So firm commitment, investment bank, best effort, issuer, right? So keep that in mind. So easy question. This is very easy. Then we have question number 31. A British company listed on AIM, formerly the Alternative Investment Market or the LSE London Stock Exchange, announced the sale of 668665 shares to a small group of qualified investors at 0.025 per share, right? Pounds per share, which is the following best described this sale, right? So it's an already listed company, right? Shares sold to a small group of investors. So not an IPO, obviously, right? Right. And then not a public sale also. This is sale to selected investor. This kind of private placement, right? So please understand IPO is first time public, but it's not a first time public happening, right? Private placement is limited investor and shelf registration is sell over time, right? So which is not happening here, right? Okay, then we go into the next question, which is question number 32. A German publicly traded company to raise new capital give its existing shareholder the opportunity to subscribe for new shares. The existing shareholder could purchase two new shares at subscription price of 4.58 euro per share for every 15 share held. This is an example of what? See, again, this is very textbook kind of question. Existing shareholder gets right. Ratio two shares for every 15 held, fixed subscription price. So existing shareholder are getting priority. Purpose is to raise capital, avoid dilution. So this is kind of rights offering. right? Right is option to buy new shares at discount. Protects your ownership 100%. If not executed, if not exercised, there is a dilution, right? So remember that. So keep this in mind very, very clearly. Then we go to question number 33, right? So again, consider an order-driven system that allows hidden order. The following four sell orders on a particular stock are currently in the system's limit order book. Based on the commonly order precedent hierarchy, which of these orders will have precedent over others, right? So what is given here? So we've been given four orders. There are different times of arrival. Limit price is different. One is a hidden order. Different prices, different times. One hidden order. So if you look at the order priority rules, which is very clearly, first is your price priority, right? For sell orders, lower price always wins. So 20.29, right? Which is given orders 2, 3, 4 beats 20.33 order. So then you have your display priority, visible orders are greater than hidden orders. So order 2 is hidden, so orders 3 and 4 are visible. Time priority, earlier orders wins. So if same price plus variability between order 3 and 4, we'll choose the order 3 which wins. So finally, uh, order 3 will win the first execution. Always remember, first we have price, then we have visibility, then we have time, right? This is PVT, right? PVT structure to go step by step, right? Very, very important. Price, visibility, and time, right? Okay. Then we go to question number 34. IOC order question is it? Uh, Zenzuli, Zenhuli has submitted an immediate or cancel buy order for 500 shares of a company at a limit price of Chinese yuan of 74.25. There are two sell limit orders standing in the stock order book at that time. One is for 300 shares at limit price of CNY 74.30, and there is 400 shares at limit price of CNY 74.35. How many shares in each order would get cancelled, right? So see, you have your buy order 500 shares. Limit price is 74.25. Available sell order 74.30, 74.35. So please understand, if it's IOC, it is immediate or cancel. So buy order execute only if your sell price is kind of less than equal to your buy price. But here best sell is 74.30. Buyer willing is 74.25. So no match possible. So no share executed, entire order cancelled. So answer is C, right? So there would be no fill, right? So please keep in mind that IOC immediate or cancel order fill, but you can immediately cancel rest. Here nothing fails, full cancel happens, right? So that's the whole idea. Then we go to question number 35. Again, a market has the following limit order standing on books for a particular stock. Keith, Paul, and Mary, right? 1,200, 400, 300. Limit price is given. Your offer size, number of shares are also given from Jack, Margaret, and Jeff, right? 800, 1,100, 400. So that's what. Now Ian submits a day order, right? Day order to sell 1,000 shares, limit of 19.83. Assuming that no more buy orders are submitted on that day after Ian submits the order, but would be Ian's average trade price, right? So again, he wants to sell your 1,000 shares at 19.83. We follow the matching rule. Seller matches with the highest bid first, most aggressive buyer. So now, first of all, it will match with 20.02 for 300 orders, right? So then balance is 700. Then it will match with your 19.89 for 400, right? 700 are gone. Then you match with 200, 900, 19.84. And then last, your, what you say, 19.70 for this one, right? So you sell to Mary at 20.02, 300, remaining at 700, sell to Anne 400, 19.89, remaining at 300, sell to Paul 20 at 19.84, remaining at 100. Next is Keith, right? 19.70, but 19.70 is less than Jan's limit, right? This is very interesting, right? So no trade, right? This is where CFA will trick you. You will think that, okay, last 100 shares goes at 9.70, but 19.70 is below the limit order, right? So last 100 shares are not sold, right? The average price will be for 900 shares only, right? So So it will be, if you do the calculation, it will be coming at 19.92, right? So this is very interesting. Limit order is minimum acceptable price for seller, never go below it, right? And calculation for 900 will happen with this 300 into 20.02, 400 into 19.89, 200 into 19.84, and divided by 900, right? So it is B, right? Very interesting. Then we go to next question, which is the financial analyst is examining whether a country's financial market is well functioning, find that the transaction costs in the market are low and trading volumes are high. You conclude that the market is quite liquid. In such a market, what will happen, right? So if there are low transaction costs, high volume, market is liquid, liquidity means easy trading, more participation. What happens is that informed traders trade more, prices adjust faster. The result is that market becomes more informationally efficient, right? So overall traders will find it easy to trade, and the trading will become make the market more informationally efficient, right? So uh, less is wrong, and traders find it hard. No, that's wrong, right? So this is wrong and this is wrong. Okay, so that is what we have. That's a big insight. Okay, so the liquidity leads to lower friction, faster price discovery, right? That we need to understand. So this is done. Okay, then we go to the next question, the last question, I guess. Right, the government of a country whose financial markets are in early stage of development has hired you as a consultant in financial market regulation. The first task is to prepare a list of objectives of market regulation, because the following is least likely to be included in this list of objectives, right? Least likely, guys, least likely. So this question has to be done a little slowly, right? So basically, which is not an objective, right? So real objective generally for such thing is that you want fair markets, you want to reduce agency problems, you want to protect investor. Uh, Anybody guaranteeing return is wrong here, right? So minimizing agency problem is good, right? But that's what we are least likely, right? Ensure that financial markets are fair and orderly, good. Ensure my investors achieve a rate at least equal. At least equal. That is not our work, right? That's not our work. At least likely is this, right? Markets are risky, cannot guarantee a return. Ensure return which gives and is free, completely unrealistic. Regulator ensure fairness, transparency, not profits. So keep that in mind, right? So very, very important, right? So okay. So with this, we have completed this chapter, guys. The bigger picture, what you have understood in this chapter, you looked at the microstructure, the orders, you looked at execution, you looked at market efficiency, etc., right? Which is very important for your, what you say, your CFA exam, right? Go back to the question, practice the question, very, very important chapter. Lot and lot of theory in this chapter, right? Lot and lot of new concepts. If you're doing equity for the first time, you might be little confused with so many concepts and so many things, right? But that's how things are, right? So you have to go and understand all these and solve the questions, right? But if you solve the question, I'm pretty sure you'll totally fine, right?